Andrew Holland, CEO at Avendus Capital Alternate Strategies, joins us right now on the show. I remember a conversation that I think Avendus and Andrew had with my colleague Sajid a month and a half or 2 months ago, talking about the high levels of cash that they were sitting in. Andrew, good morning. Have you looked to deploy some of that cash, and is the market giving you the opportunity currently because of the slightly volatile nature over the last 1 month to do that?
No, I mean, when I spoke to your colleague, the index was more towards that 10,000 on the Nifty, so we did deploy more, but it was in particular sectors and stocks which had been particularly beaten down too much. So the market's risen since then. So we're not seeing, it's not as compelling as it was before, but it's still, I'm still not a negative on the markets. I think it's kind of quite interesting that back in July, August, when the oil price was at 80 odd, markets were hitting highs, and now it's at 63. We're where we are, and given that I think the RBI is pumping enough liquidity into the system. I think we're slowly getting out of that the problem areas that people were so worried about 2 months ago, and really a part of this month as well. So I'm on the margin more bullish than I have been all year, and continue to remain so. But there are challenges, as we know. We've got the state elections, which will be a sentiment impact for 1 or 2 days, but of course we've got at the end of this month the G20 meeting, which might either throw up that the trade war with China is not going to happen, or it's hardened, and I think that's where the markets are going to focus towards the end of next week, probably with some optimism that things will move ahead. And if that's the case, then obviously our market will participate in any rallies that global markets have.
Okay. Just want to mark Kesoram though before we ask the next question, because that stock is on a tear, 11% now for Kesoram Industries after the 20% up move yesterday. So keep that at the back of your mind. Big strong move on very high volumes, almost 1 million shares traded already on the NSE. Andrew, things have changed in the last couple of months. They always do, but more so in the last couple of months, in the sense that corporate-facing banks, which were the top draw about a month and a half ago, are no longer as cheap as they were. IT, which everybody was saying is overbought, is now at least 13, 14, 15% lower than what it was a couple of months ago as well. If you were to deploy more money, because I heard you mention that at the margin you are more bullish, what do you think will lead the gains, be it on the index or be it on specific sectors? What are the themes that will lead the gains for the next 3 months to 6 months at least, if not longer?
So I think that there's a few things on my mind. One is that the rupee has stabilized, and it should be around this 71 to 73 level for the next 6 months or so. So I'm less concerned about the rupee in moving in any direction very, very swiftly. And whilst the IT sector has reflected that the more positive signs for the rupee, it is still depreciated this year, and it will still be a tailwind for the tech companies. So I think technology is still, or IT is still an area which we like, and we'll look to deploy in certain names there. I think the banking sector, 2 parts to it. One is obviously the private and the corporate banks continue to remain a buy. They're going to continue to take market share from the more weaker NBFCs, but also the PSU banks. But the PSU banks is becoming a little bit more interesting, and maybe it's a 2019 play, in that if we are coming to the end of the NPA cycle, then that's probably an area which we might want to rent more, not quite own the stocks, but rent them, because we'll see some rally in 2019. And again, perhaps early, the kind of infrastructure, capital goods, working on the basis that whoever comes in terms of the new government, will continue with infrastructure spending, and the economy will continue to grow at 7.5%. So the back end of 2019, you'll start to see the private capex cycle turn up. So that's another sector which we're looking at more closely. So those are the kind of areas. I think in the more volatile kind of few months ahead of us, hiding in defensive sectors such as FMCG is always going to pay off, and plus you've got the great growth story there. So FMCG is probably still one of my favourites.
Right, Andrew. Good morning. In that list of yours that you spoke of, do we expect real estate to turn the corner? We've got low ownership in some of these names, but the stronger names which can weather out the storm that we're seeing from the liquidity side regarding funding coming their way through NBFCs and a relatively stronger balance sheet, you think that those names are worth a look at from an investment point of view?
It's a great point, and it depends on how much you can sit around and wait. What I've noticed from a lot of the building companies that they've been doing very well in affordable housing, and that's been helping their kind of profitability and cash flows. There's still strain at the top end of the market, and we'll keep reading about the top end and how much supply there is. But gradually, as affordable housing picks up and it continues to do well, aspirational India will start to move up the ladder as well. So we're probably a little bit away from being kind of constructive on buying yet. But I think we're not so far from the worst being over for the property companies. But it's probably a late 2019 story. But obviously at the moment valuations are pretty compelling, so it's worth taking a look. But I'm not sure I'd dip my toes quite yet.
Just coming on the auto companies as well, while the disappointing festive season has been seen for most of the auto names there, dealers are talking about having an inventory pile of about 50-60 days, which has not really come off in this festive season. That being the negative, the positive being obviously the calming off of crude oil prices and whether or not that reflects on petrol and diesel price, and the cost of ownership of these vehicles starts to come off, which makes people who wanted to buy cars earlier on, which kept the decision on hold, to actually go ahead and buy those cars now. So, I mean, a tug of war there within the auto space. Do you see things changing materially?
Yeah, you might be right at the margin that people put off from buying because of the higher petrol prices, but it's a very marginal call. The auto sector, whether it be two-wheeler or four-wheeler, just had a tremendous run over the past few years with very high growth rates, and they'll continue to have reasonable growth rates, but of course, we all get super bullish on that the growth rates will continue at their very high rates, and that's not going to happen all the time. So all you're seeing is really a reflection of a slower growth rate. Obviously, people just not spending as much around that festive season for whatever reasons, or maybe they bought before. So it's not a sector I can get excited about now. I think there's one or two companies in there which, through their own new products, will continue to take market share and do very well. But I think the kind of whole re-rating of the sector has taken place, and it's time for a breather there, or consolidation in share prices. It's just had a great run. So I don't think I'm a big bull of the auto sector. One or two companies will do exceptionally well, and that's probably where we'll look at. But I think it's all in the price at the moment.
Okay. Andrew Holland, really good having you. Thank you so much for taking the time out and being with us today and giving us your thoughts.